Cool. So I deliberately try not to ask you about Canadian companies because I know we have listener questions around that. So we might just jump some of these questions and see what you guys have asked us. So Carlos Terry has asked us the first question, and this is around Johnson & Johnson. So he wants to know, what does it mean for us as shareholders when a company has a spin-off? For example, Johnson & Johnson looking to spin off their consumables.
That's an interesting one, though, because when you look at Johnson & Johnson, and a lot of investors make the mistake thinking that they're like almost half consumer cyclical, consumer staples, and then the other half is healthcare. And it's actually not true at all. Like the consumer is like very small portions. And now with those lawsuits, it makes sense for them to just get rid of it. And I actually did an analysis when they announced it, and you're going to end up as a shareholder having like two different companies. One that is growing, which is pharmaceutical. Actually, like the medical device is growing, but not that fast. It's like pretty much stable. And then the big growth from Johnson & Johnson that came for the past 5 years all came from pharmaceutical. So they make specialty drugs, and they're harder to replicate. So even though their patents expire, it's going to be better for them. They're going to be able to surf on those cells a little bit longer than regular drugs. And even then, they're very innovative. So that works well for them. And the other part is the consumer part, like consumer products, which is pretty much going sideways, even slowing down a little bit. So I do have shares of Johnson & Johnson, and once I'm going to receive like shares of like one of the two Johnson. I don't know how they're gonna like call both of companies. I'm not sure I'm gonna keep up the with the consumer part. I don't know about you guys, but when I dissect the company and I separate everything, I didn't fall in love with that part.
I had the same. I did similar exercise like you. I think they had no revenue growth almost over the last 10 years. I estimate that the spin-off will be probably around 15% of total share price, I guess. And if I get the stocks, I own already enough consumer staple. So to have such a small position added to my portfolio, I probably clean it up every time. When it's spring, I do spring cleaning, and then I'll probably sell it and buy something decent back for it. But we'll see. If they price it really at a cheap price, then it will be stupid to sell it. But I don't expect a lot of growth there either.
No, and they will likely struggle to provide a dividend growth policy as well. I mean, some consumer staples, like I just can't stop thinking about Kraft. When like before they merged with Heinz and then went back public, even before that, I was like, those guys, they don't invest enough in products and in marketing, and everything is going sideways with this company. And now they came back public and they had even more problems and eventually cut their dividend because they were not growing fast enough. And I kind of like, I fear that the consumer part of Johnson & Johnson is that like hiding behind the rest of the business model, where nobody cares if they don't grow, because you look at the overall picture and it's like, yeah, this business is doing fine. But now I think that the pharmaceutical will continue to increase its dividend. The other part, I'll be very cautious with this one.
Yeah, we are effectively getting a biotech company, right? There, so which is actually also really interesting, and I hope it will take also a bit the cap off of the share price. It will be interesting to see if the Clockwork 7% earnings plus dividend growth will stay the same that we're so used to, right? It might actually also be more volatile now the consumer business goes out. Let's see.
Cool. Manny Mystery has asked us, he would like to hear some of your insights on big Canadian banks. He is long on ticker BMO, which is 81% of his holdings, I think. And I think you've answered a little bit, but he wants to know why Canadian banks are run so well.
All right. So there are 6 banks, as I said. You have classic banks like TD Bank and CIBC. Those are like more closer to the savings and loans. What is interesting about TD Bank is they have 1/3 of their business now in the US. So they expanded in the States, especially after the financial crisis. A lot of Canadian banks found great opportunities to buy like smaller branches over there and establish a good core business in some states. So TD is doing very well. Their underwriting process to write loans is very good. Risk management, A+. Not too in love with CIBC, to be honest, because they're kind of like a little bit behind on everything, a little bit too classic to my taste. And it's good to have interest income, but at one point, I think for banks, the real money will be made through capital market and wealth management. In that regard, BMO is Bank of Montreal is probably one of the most advanced. They started by acquiring a private bank, Harris Bank, like 20 years or 15 years ago. That was like one of the most important private bank in Chicago. So they're very strong in wealth management, and they were among the first Canadian company to create ETFs, Canadian ETFs. So they're well input there. Obviously, if the more you make money from capital market, the more volatility you will bring to your financial results. So you're going to have sometimes amazing results with BMO, sometimes not too good. Recently, they acquired also more branches. I can't remember from whom, but I think it was from a European company, if I'm not mistaken. Not too sure why they want to acquire more branches, especially in a world where we're trying to move more digital and nobody likes to go at a bank, actually wait in line, talk to a teller. That's not necessarily the future for banks. So I'm not too sure why they make that move. And my favorite two would be National Bank that I discussed earlier and Royal Bank. Royal Bank, why? Because it's one of the largest bank in Canada, pretty much like number one, number two with TD in terms of assets and market capitalization. But Royal Bank has 50% of its business coming from wealth management, insurance business, and also capital market. So they're well diversified, and that's what I like about it. And especially because there's a lot more money to be made with this transfer of wealth. We had like a huge baby boom that all those guys are now like 65, 70, 75. So that fortune is being transferred to the new generation. And you'll have a lot of questions about estate planning and wealth management. And this is probably where they're going to be able to make a lot of money out of it.
Or they ask those questions on FinTwit.
Yeah.
Cool. And Manny has asked a second question around, do you feel there's any undervalued Canadian gold miners?
I'm not a big fan of the energy sector and the commodities as well. And I'll tell you why. I don't know what's your take on those, but what I don't like about them is their entire business model depends on the price of that commodity, like regardless if it's gold or if it's the oil price. And those are quite volatile. So one day they're making a ton of money and the next day they're barely bankrupt, so it hurts cash flow. And when you have like such a bad cash flow going up and down all the time, that makes very bad dividend growers. So I'm not a big fan of gold mining stocks. If you really want to go towards gold, I would go for a company like Franco-Nevada, which operates a royalty-based model. So they have like lands, and then the gold miner takes the risk, and then they just pay a royalty on what they found. So they have virtually no debt, and they have been one of the rare dividend grower in Canada for the past at least 10 years. So I would go with this type of company instead of trying like gold was very popular in 2020. The ounce of gold was supposed to hit $3,000 by the end of December of 2020, and yet we're 2 years later down the road still waiting for that $3,000 to happen, and we're definitely not close to it. So yeah, never been a fan of gold, and just too much volatility and not enough value out of them.
Yeah, no, gold is always something you have to time, isn't it? You have to, it goes up and down. You need to get in at the bottom, and you just never know when that bottom's in. So I'm like you, I stay away. Billy Pritchard has asked you specifically, what are your core Canadian dividend growth stocks?
Core Canadian. I have National Bank and Royal Bank, obviously. I have some railroads. Canadian National Railway. What is great is it's a bit different than what you have in Europe, I guess, because for us we don't travel much with trains, but we do them we do use them to transport products. And CNR is the largest railroad in Canada. It goes from east to west. It goes to the States. Like strong dividend growers as well, low yield, but you cannot really replace railroads. It's an asset that has this quality, like this barrier to entry that is almost impenetrable. So they exist, and that's pretty much it. So this is the part of the company that whenever the market goes down, this one I never looked at it because I know that they're still going to be there anyways. I have TELUS, telco company, Fortis, utility, and one of my favorite is actually Alimentation Couche-Tard, who almost bought Carrefour in France last year in January of 2021. It's the second largest convenience store in the world. And they have grown by acquisition for the past 25 years. They have a very experienced management team. So we were talking about management team at Unilever. Totally the opposite at Alimentation Couche-Tard. They pay the right price, and when it's not good, they just let it go and they move on to the next deal. So that's very one of their strong point. And for those who are concerned about the major shift towards electric vehicle, they do have a lot of convenience stores with gas station and supercharger now in Norway. So they use Norway as their laboratory, and now they will start implementing superchargers in the US and in Canada. And their goal is basically they have all the locations. And they're thinking, well, while you charge your car, well, we're going to convince you to come inside and then grab a snack, have buy your beers or whatever for the weekend, and they're gonna be able to make a lot of money out of that too. So it's not just about yes, there's a huge volume coming from fuel cells, but most of their profit is coming from the convenience store.
It's funny that you say that. I was the other day speaking to someone with a Tesla, and this person told me, I love going to IKEA or something like that because you can charge your car for free. So I effectively get a lunch for free, I get to spend time there. And I think if it's for such a company, if they have some solar panels on the roof or something like that, and they can supply electricity for free, it's a great business model because like pulling people in like a magnet, because they can charge for free, and at the same time you get them to really spend time there. And I think this kind of services, it's not a lot spoken about, right? But I see it's quite interesting to approach it like that.
Yeah, definitely. And especially in North America, where distance is a huge thing all the time. Like there's a lot of people, they're driving like 1 hour, 1 hour and a half to go to work every day. Well, at one point, those guys, they will need to charge. It's going to be hard a little bit. And focusing on that like special service that will become the norm eventually, I think it's smart.
Yeah, cool.
So we have a question here from Alexandros, and it is quite an easy one probably for you because you've mentioned the company, but it's Fortis Inc. or Canadian Utilities Limited?
Yeah. So Fortis, FTS, trades both on the Canadian and the US market under the same ticker, so pretty easy to find. They're like one of the, I would say, the mother of dividend growth in Canada with 48 years of consecutive increase. And what I like about their business is that it's super boring. It's like 99% regulated utilities. So what they do is like, it's a perfect edge against inflation. So they have those assets across North America and a few in Bermuda, and then they just go see the regulator and say, hey, there's inflation, so we have to increase our rent. So there you go. So we increase our rates, and then they move on. So I kind of like those very boring business, which I found, since I'm 100% invested in equities all the time, they work as what I call deluxe bonds in my portfolio, meaning that they will pay a decent yield. It will increase over time. And I don't expect much capital return out of them besides the dividend in growth. But over the long period of time, it will still pay a little bit better than a bond. So, and it will bring that stability, the fact that they're generating cash flow all the time. And it's funny because I was talking about the dividend triangle at the beginning of this this podcast, where I'm looking at companies showing revenue growth, earning growth, and dividend growth. And Fortis is a perfect example of that. It's pretty much straightforward, between 5 to 6% every single year, clockwork. The three metrics goes almost perfectly like each of them. So you can expect that for several years to come on top of it. So if you're afraid of inflation, if you're afraid that the market will crash, Fortis is definitely a fortress.
I can hear it already. You love monopolies, right?
Yeah, well, they're easy, right?
Yeah. So if I hear you talking, the first thought that comes to my mind is like, we should send some Spanish politicians to Canada also for an internship, because our Spanish listeners, they don't trust their politicians. They have some great utilities in Spain, and dividends are just unsafe because there's kind of the thinking, I guess, what I hear from our Spanish listeners, like that the government will want to pull away from those assets. Like, it's unfair that those companies are earning money. It should go back to the population because prices are rising. And I guess is the thing that we speak a lot about in this podcast, really the mindset difference between Europe in general and Northern America, where it's more capitalistic, I guess.
Yeah, actually, it's kind of funny you mentioned that, because in Quebec, we have Hydro-Quebec, which is a public company, but not public, like not trading on the public market, but it belongs to the government. And it's like one of they're generating hydroelectricity, obviously, and it's probably like the most valuable asset the government has. And at one point, there were like discussion about putting it public and doing an IPO. And then there's a lot of people, they're just like, yeah, but you don't realize, like, we're paying such a low price for energy right now, like in the province. You don't want them to go public because it's going to double. And, and it was not a popular politic vote. So whatever is public right now will probably stay as is, because it would cost way too much for the government to buy back. But I don't see it the other way around either. I think it's going to stay this way on both sides.
Lucky you.
Yeah, and it's actually funny because the government is receiving like more than $1 billion a year in dividend from Hydro-Quebec. So
they're like dividend growth investors.
They are.
Yeah. Nice.
Okay, Dividend Wave has asked you for an attractive Canadian stock, if not part of the stock pick of the week. Which SUP, that's part two of the question, which SUP was bought?
Yeah, the SUP is it stands for stand up paddling.
Cool.
and I was asking last year because because of the pandemic we couldn't travel much, so we decided to spend more time in Quebec, and I fell in love with SUP instead with stand up paddling. I wanted to do some with my daughter, so I asked my Twitter followers, like, which is the brand, or like what should I do with that? And I ended up like buying like two like entry level SUP, but that are inflammable. So not flammable, but what's the word?
Inflatable.
Inflatable. There you go. Yeah. Of course, it's gonna take up in flame. It's on a lake, right? Yeah, inflatable. Thank you for that. So yeah, and actually, it was great, but I can't remember the brand. But yeah, 10 minutes of pump, so it's good for the arms before you go on the lake. And I live like 15 minutes away from a big lake here in Quebec, so that was like the perfect setup for me and my daughter. We put them we have like a big Jeep, so we put them on the Jeep. We go there, have fun over the summertime, so it's great. But yeah, right now it's like minus 30, and then we have 3 foot of snow, so no more SUP for a few months.
And is that minus 30 Fahrenheit or Celsius?
Celsius.
Hallelujah.
Oh yeah, it's been, and I'm running like 4 times a week, and I can tell that this week was quite brutal because it's not stopping. Usually we have like a few days of bad weather like this, but now it's been 2 weeks of like minus 25, minus 30 every single day. So yeah, we stay inside.
Wow.
It's crazy.
So maybe then the next question then, to keep you warm, from Ira Investor, what has been your biggest investment mistake in 2021? Is his question.
In 2021, actually, I didn't make any mistake because I didn't make any move much, right? So that was a good thing. However, one trade that didn't go well, but I kept it anyway, is I bought Viacom CBS, ticker VIAC, right after the hedge fund was forced to sell it, and then it went around like $40. I was expecting that the stock would recover a lot faster because, I mean, it's stable telecommunication company, generating a lot of cash flow. The valuation is super low. So I thought, yeah, that's just like a good speculative plays. What I like to do with my portfolio is I have like 90% of my portfolio, which is really buy and hold dividend growth focus. And then I will have like a 10% that allow myself to play with. So sometimes it's a dividend play, sometimes it's not. So Activision, Blizzard, and Viacom are two examples. So one was very successful. The other one, I'm still waiting to make it happen. I don't see it as a mistake. I see it as a bad trade, obviously, because I'm down like 20% on it or something like that. But I still believe in my investment thesis so far, so I'm going to keep it. What was rough in 2021, though, is it was one of the rare year where I didn't outperform the market. So I was doing well. I mean, it's kind of funny when you say, "Oh, I'm up like 17%," and it's not good enough. It's kind of weird to say, but it's probably the result of having my portfolio doing so well over the past 5 years that at one point or another, and this is maybe like a good lesson for all investors, not trying to chase yield or return year after year, but look at the big picture. So when I look at 2021, I'm like, yeah, I lag big time. But when I look at the past 5 and 10 years, I'm like, oh yeah, I'm way ahead. So sometimes, it's just a matter of like having a bad year because you made those returns in the past and the market is just catching up. So
Yeah. It's interesting that you say that because we get this question a lot about how we're doing compared to the S&P 500. I've not been beating it over the last 5 years, for sure not. But it also makes no sense for me actually to compare, and I'm curious how you looked at that, because for me, I'm buying dividend stocks, and if you look at an S&P 500 or something like that, my portfolio isn't even supposed to be constructed like the S&P 500. So I always have a feeling like if I start to benchmark myself with the S&P 500, I'm kind of creating this false illusion to myself. And I said at the same time, I'm not focused on like, okay, otherwise I could as well put my money in the S&P 500 because I want to live off the passive income. And the S&P 500 for me index is totally not attractive from a passive income point of view. So I'm wondering how you look at that from a benchmarking point of view.
I will use two type of benchmark. The first one is, and I totally agree with you on your point about looking at the S&P 500, and I will also look at the TSX, which is the equivalent in Canada, the TSX 60. But obviously, the way they are built does not reflect my investing strategy. So it's like one thing just to say this is more as a total return approach to see, am I losing my time that much? But if I would be close to it, wouldn't matter, because as you said, the purpose here is to have a growing source of income from dividend, not necessarily to beat the market. So that would be the first benchmark. But the second one is I look at 2 dividend growth ETF. So, and the reason why I look at them and say, okay, so obviously when you pick your own stock, you have to do your own due diligence. You do like today we've mentioned like a bunch of stocks, but it would be foolish just to open your brokerage account and then type it in, right? You need to make some, you have to put some work into it. So is it worth it versus just buying a dividend growth ETF? And so far it is, but because what is great about ETF is you get that instant diversification at a really cheap cost. But when I look at their top 10, 15 holdings, there's always companies that I would not ever buy in my portfolio. So I cannot wrap my head around having them indirectly through that ETF, and this is why I would never buy ETF for that reason.
And can you buy American ETFs like the Vanguard Growth VIG? Can you buy some? Oh, lucky you. In America, in Europe, they're having this UCITS where the government thinks, the European Commission thinks that they know better for us to protect us. So they want us to buy crappy ETFs that come from European banks, high ETF costs compared to those American ones. Poor dividend performance, for instance, and they say that they are doing that to protect us. So I know I'm a bit complaining today about this, but it was this week in the news again, and it just pisses me off because they are belittling us as investors, like we can't make any choices, and they literally push crap towards us, which then gets being purchased by our pension funds, right? They buy this crap then again. So it's like crap over crap over crap. And nobody understands why. They say because they're... because if those, let's say Vanguard would then need to comply with the standards that we have in Europe, but it's like a false, a false perception of risk, in my opinion, because you just have underperformance for over a decade.
Yeah, and especially when you look at Vanguard or iShares from BlackRock, which is a company that I love actually. They're quite performing ETFs, so there's no reason there's no rationality behind that saying, no, you should not invest in great ETF at very low cost. So that doesn't make sense.
We have iShares and such, but they need to have UCITS, so we cannot get ETFs like with ticker symbol SCHD swap. I believe it is. VIG. There are some tricks there with option trades, but it's almost impossible for the regular home gamer. Anyway, I'll stop my complaining about politicians before you know it, they give me a tax hike, which they, by the way, gave at the 1st of January. So shifting my mind because I'm getting crazy from this. Maarten is asking us whether we are looking at ASML. It's probably more a question for you, EMF, and myself, after they doubled their dividend this week. And he believes it's actually not that expensive if you really look into their future growth prospects from a free cash flow point of view.
Yeah, I mean, it's hard to argue that it's not expensive. It has a PE ratio of 42 or something, I believe the last time I looked. I mean, the Decline of Capitalist spoke about this. He always talks about this company. He's been telling us about this company for a long time. The time to buy that was probably March 2020. It dipped around 200, 250. I don't know. It's a great company. They do great things. I don't know if you're familiar with them, Mike. They pretty much make machines that the chip makers rely on, like Intel and all that. They use lithography and all sorts of techniques to make these chips. But they're a quality company, but too expensive for me.
Yeah, and a monopolist.
Yeah, I mean, there's nobody else to do what they do. It's a bit like your Canadian radio.
Yeah.
I mean, it's a hard gig to get into. They seem to have it all sewn up, and it would be hard for someone to come in and take over at this point.
Yeah.
How about you, European DJI?
No, nothing. Not interesting for me. It should at least half in share price before I get interested. So
at least, yeah. But hey, they're a Dutch company, so I thought you might have.
Yeah, I love them as a company, but not as a stock for me. It's just overvalued from that point of view. It will take me like 20 years for the dividends and the earnings to grow into the amount I would like to see out of my investments. It's a clear overvaluation, but I understand why people love this company. I mean, I honestly believe if ASML stops selling machines, there's a lot of shit going to happen in the world, because cars will not be able to be produced in the long run, because there's a shortage in chips that they're kind of trying to fulfill with the production of machines. So it's probably in the top 3 companies in the world at the moment. If you would like to list me 3 companies, 3 businesses, I think it's in the top 3 in the world with Microsoft together.
And are they growing double digit? Because I don't know this one, but like in terms of revenue and earnings, are they like very fast? Or?
Yeah. I mean, I think I don't know exactly. Don't pin me on, but I think one single machine probably costs more than 100 million or something like that.
Okay.
We're talking about these kinds of pricing power.
So they're not worried too much about inflation.
No, not at all. Not at all. No, not at all. I think if they really want to, for instance, TSMC is a large. I mean, every chip manufacturer needs their machines effectively, so you can't get around them.
Okay, Catalan dividend investor has asked a great question actually. Are there any things you miss in life before you are financially independent? Now, I know you said you want financially independent, but maybe back before you made the transition to be as free as you are.
So just to be clear, I'm not sure what financially independent would mean, actually, depending on like who like defines it. I like to see myself as being a retiree in a sense that I do what I want right now and when I want it. So before recording, we were discussing that we've been in Vietnam for a month in January of 2020, right before COVID hit, and that would be a good example. You know, I was like working maybe like 10 hours a week there, so I was still working, but I could take off for a month, do whatever I want during that time. And when I came back, I still had like plenty of time off during the summertime and so on. So it was just like I work all the time and I'm free all the time. That's pretty much like the way that I've designed my life now. Before that, I was, as I mentioned, a private banker, which means that I had a lot of like objective to meet at the end of the year. And one thing that I didn't like is those numbers, they reset down to zero every first of the year. So you're always running after your tail all the time. So I don't miss that at all. One thing that I realized I missed was, since then I work online, so I have like my office at home, so that's fine. But then with the lockdowns and with the pandemic, I realized that I didn't miss not seeing people throughout the day. But then after with the lockdown, I couldn't see my friends or other people over the weekend as well. And then I realized, oh my God, that I missed that a lot. So that was one thing that was completely different, because with my job, I was working with clients, so always in contact with people, and I just love that. But besides that, I mean, no, like I said, my level of risk tolerance has been through the roof since I went through this trip. And after that, I don't feel uncomfortable. I had of course, I had like bad days. I had like, at the beginning, I was working to make enough money just to pay for my mortgage at the end of the month, which was kind of a bit stressful. But over time, it has been just so much fun. And maybe one thing that is weird is sometimes it's lonely, because you're in your own mind, you're doing your own business, but you're kind of like creating this world around yourself, which nobody quite understand what you're doing. And then people are just like, you're working from home, like you have like screens all over the place, and then like those lights and stuff. What do you do exactly? And I'm like, yeah, I'm helping investors to build up their portfolio and invest with more conviction and build their retirement. And they're just like, yeah, I don't. So you're a consultant? I'm like, no, I'm not. And then there you go. You just like, you just can't explain what I do. So yeah, sometimes it's a bit lonely. But fortunately, I have a partner, so I can wind down with him and then just say, yeah, like I just feel alone today. So, but yeah.
Nice.
Cool. Centrino has a question for you, your European DJI. He wants to know why Microsoft is your biggest holding, as its dividend is minimal.
Really simple. I started. I bought my largest chunk at $40. So it just grew since then. I bought a little bit more at $80. For me, it was clear when Satya Nadella came in, and it was trading at a yield also around 2.75% there. I read the book from Satya Nadella, Hit Refresh, around that time, where he was in the midst of the transformation, and it was clear to me that this guy would change Microsoft forever. He came from the Azure business division. So it was written all over the wall what would happen to Microsoft in the upcoming years here. And I saw Amazon was already knocking it out of the park with AWS. And then I work a bit in IT, and I know that, I said, companies want to have options, and also Amazon is a competitor or a risk to many businesses and many industries. So not every company wants to have their data stored at Amazon. Microsoft has always been neutral in the ecosystem. They are not threatening, I said, Walmart to take over their business as well. Yeah, they are not threatening to take over the healthcare business. Yeah, so for me, it was so clear that Microsoft would be able to get something out of it, and it's easy to say afterwards, but I was really convicted around that, so I just grew into it. It's probably one of the stocks I spent the least amount of money on in my portfolio.
And that's, I think you're bringing a very good point. I have like a big chunk of Microsoft as well, but one of the reason, and I think it's fundamental for a lot of investors, is to let your winners run.
Yeah.
You know, when you have a great company that is doing great things year after year, why would you sell it? And
Exactly.
yes, eventually it's gonna be huge in your portfolio. But I've done that with a few stocks, and that probably explained most of my returns. You know, so you are allowed to make smaller mistakes, but if you let your winners run for a long time, you get with like hundreds and hundreds, and sometimes 1,000. Like in your case, you're getting close to 1,000% return. Probably you get it with the dividend. That's amazing.
Yeah.
You know,
I'm now yield on cost between 4 and 5%. Yeah.
So it's a high yielding stock.
It's a high yielding stock for me on cost, right? Yeah, definitely. Yeah.
Good. So B has asked 2 questions. The first one is, when will Montreal Canadiens win the Stanley Cup again?
Oh my God. I didn't expect that to have that on your podcast. Oh, that's a rough one. So here's the thing.
I don't know what it means.
Okay. So that's a very funny, but I'm doing a lot of webinars. And after the end of the webinar, we do like a long Q&A session. And from time to time, I talk about hockey, like as an analogy, or I just talk about the Montreal Canadiens, which is like one of like the most successful sports team in the world, along with Manchester United and then the New York Yankees in terms of championships won, like in their history. They're at like 24 championship won. The problem is this year they're going absolutely nowhere. And last year there was at the Stanley Cup final, but they kind of like just, you know, when everything falls at the right place, it was just like destiny, but definitely not because they were a strong team. So they just happened to go to the final. But this year they're good. They're the worst team, like across the 32 teams. Like they're beyond bad. So when are they going to? And they're locked up with so many long-term contracts, which like some players are not doing well, and like our best defenseman is not playing this year and is likely going to retire. And we have Carey Price, which is like one of the best goaltender in the world, but he hasn't played this year. He had like personal problems, and then he had like one knee that was completely scrapped. So basically not going towards the right direction at all. So I don't know, maybe like now we have like a new general manager, we have like a new VP. So hopefully we're going to end up at the end, like last pick up like some good draft, some young players, and it's going to take a while. So I'd say at least a good 3-4 years before we get competitive again and maybe think about something. So yeah, those are going to be rough years.
and excuse me my stupidity, but are we talking about ice hockey or real hockey?
No, it's ice hockey.
Okay.
Like for us, it's real hockey. There's no other hockey.
Okay.
But that's good. I mean,
I thought the one on the field, which is also an Olympic sport, I think. Is it?
Oh yeah,
I have no clue anymore. Anyway,
no, we don't follow this one. See, but I mean, I don't mind. Here in Canada, we have 2 types of football, right? So we have your football, and then we have North American football. So it's all good.
And the second part of that question was, do you have any idea which company in Europe or US that is like, you say this company's name much better than I'm going to say, but it's Alimentation Couche-Tard.
Yeah, that was pretty good actually. I don't think so, because the largest one is 7-Eleven, which I think is Japanese, if I remember correctly. Besides that, I don't think so, because it's a very highly fragmented market, especially in the convenience store, and most of it are just like super small businesses, which makes this industry very interesting because you can like buy small convenience store chains everywhere all the time. But yeah, no, I'm not aware of any equivalent. And if you look at grocery stores, that's completely different. And this is one of the reasons why the stock actually dropped by 10% when they announced that they wanted to buy Carrefour in France, because it was a grocery chain. And that has nothing to do with convenience store. You're talking about high volume, low margin, while convenience store is completely the difference. It's small margin. It's a high margin, low volume business. So we're not seeing like there's one is perishable, the other one is like selling goods all the time. Just like those Doritos and other snacks, they last forever. So you don't have to mind about the expiration date. So yeah, no, I cannot think about anyone.
But I believe they own Circle K, right?
Yeah, they do.
Yeah.
Yeah, because we have the gas stations here in Poland from Circle K.
Yeah.
Okay, it's from them. Cool.
Actually, it's kind of funny because even on my trip in Vietnam, they had Circle K everywhere, and I was like, I feel like home.
Wow, nice. I didn't know that. Cool.
Cool. And then the last question of the day is from Ryan, and he asks us, what are we going to do with Unilever if it continues to correct and go down?
Buy more. I wouldn't know what to do else. I don't see the company going bust or anything. Like I said, this company is bigger than its management. So for me, below 45, I typically nibble in a little bit. It's what I did this week. I don't buy all at once. It's kind of my safety net to always have a time period in between to prevent catching a falling knife. But I just continue buying Unilever. It's not a full position yet.
Yeah, it's actually on our buy list at Dividend Stocks Rocks too. Following this summer when it dropped the first time, it's always hard to catch a falling knife. So obviously this one is a little bit behind right now. But I think today's market is a good example where everybody expects to like earn 20% return on any stocks after like 3 weeks of holding. It's kind of like this kind of market, and then people are just going crazy because they have to hold a stock for 6 months. And I'm like, dude, you should hold it for like 60 years, not 6 months or a month,
Exactly.
So I think that whenever the tides is going to turn around, companies like that, boring companies like Unilever will do well. So yeah, it's just, you buy it, you forget about it, and that's it. Stop talking about it, Just erase that line in your brain and just come back in a few years.
Yeah, we had it also like last week with Cameron Stewart, right? And I like this mindset a lot, like thinking like, okay, what would be the ultimate widow stocks? Yeah, those stocks that if you die, your wife doesn't need to touch, would probably not even know of its existence, but just see money appearing on the bank account every month. Those are the ultimate stocks, I think, for dividend growth investors.
Yeah, definitely.